Hello and welcome to Strive Defense Dialogue. Today we have invited Major General SQ Ahmed once again to our channel. Sir, welcome to the channel, sir.
Thank you, Brigadier Bhatia. Thank you very much.
Sir, the last episode that we had done regarding financial management was liked by many, and we received requests from our audience to do one more. Like you are aware, sir, our channel, there are a lot of officers who are veterans. So it is general feeling that mutual funds are much safer, though it may not grow at a very fast pace as stocks. So that's why we requested you that let's do a program on mutual funds exclusively, sir. Sir, the stage is yours. Please tell us what are mutual funds and why they are better for especially people like us who have retired to invest in mutual fund and not maybe go too deep into stocks, or shall we have maintain some sort of balance profile in something in stocks, some in mutual funds, some in FD, just to make sure that you are comfortable. Sir, one thing is for sure, most of us are more comfortable putting it in FD. But yes, mutual fund is the second best option, sir. Whatever this mystery is, sir, for us, please tell us what exactly is the benefits of mutual funds. Over to you, sir.
Thank you, Brigadier Bhatia. Sorry for the bad throat little bit, but I think I'll make it through. And very thankful to all of you to give me this opportunity once again. And to begin with, what a lovely day, a happy Easter to all of us. And let's talk finances. Before I came on this platform, I thought yesterday that I must share certain facts on LinkedIn, my LinkedIn account, as to what mutual fund is like for all those who see. And I got a very, very positive feedback. It was seen across almost 150 odd people. And what I put across is what will generally answer the query or set the mindset of most of our viewers. I would like you to show the next slide where I have actually put down what mutual funds are. If you can go to the next slide. Yeah. So what I have written here is that mutual funds are great instruments offering incredible growth opportunities over long term. With over 45 fund houses that are managing these mutual funds with 2,000 plus professionals who manage these assets for us. And the result, the SIP accounts have skyrocketed from 1 crore in 2016 to a staggering 8.2 crores. 7.2 crores accounts have been added in just 10 years. The mutual fund industry itself has ballooned from 9.16 trillion to 54.54 trillion as it stands on 29th of February
Sir,
2024.
sorry for interruption, sir. Please come closer to the mic or speak slightly louder, sir. Sorry, sir.
Okay, okay, fine.
Yeah, now you're better, sir.
Yeah, fine. Okay. So, what I was just mentioning that the growth of the industry in the last 10 years is almost sixfold, as you can see on the what I put on the LinkedIn. And on an average, 15.4 lakh new mutual fund folios are being added every month. Now, where are we in this? I think that sums up as to what is the power of mutual fund or what is the reach of mutual fund or what the investors think that mutual fund can give to them. So, with this as the background, let me tell you what I'm going to cover today. I put it in the preview in my next slide. So, very simply put, I'll cover it in a very simple steps. What is a mutual fund? Why mutual fund? I think that's my question. And then there are different categories, types of mutual fund. Then a common question: is it expensive to invest? Am I charged certain fees when I invest in mutual fund? How to select? How many number of mutual funds should I have on my folio? Where to buy it? How to buy it? What platform? And then the obvious question: what would be my returns? And will I be paying any taxes on it? So this is a sum total of what is going to cover in today's this thing, and anything else we can come in the question answer session if there are any. So coming to what is mutual fund, if you see this pictorial depiction, mutual fund is nothing but pooling of money where this money is managed by a group of professionals to invest in certain stocks. Suppose there are two people who want to buy two stocks, they together have got 100 rupees, but the stock is of 75 rupees. Individually, they cannot buy the stock because they only have 50 rupees. But mutually, they can put their money together, 100 rupees, and can buy 1.25% of that stock. So that sum totals of what is mutual fund. And this whole rigmarole is processed and managed by professional, and it in the end gives out the NAV, the net asset value of each portion of the stocks that have been bought by the mutual funds. Now, what mutual funds can buy, etc., I'll cover later. If this is understood, let's go further ahead as to what mutual fund advantages are. It's self-explanatory, this slide. It mutual fund actually gives us lot of diversification. I mean, the amount of diversification that we received here is phenomenal, that I'll explain to you when we analyze a particular mutual fund. Now, it is very liquid. You can give an order to buy, you can give order to sell. Within 2 days the accounts are settled. Rate of returns are reasonably high. We will talk about it. Safe, it is safe and transparent because every day you can track your NAVs. You can manage this. It is inflammation beating, so it takes care of the inflation. Expert advice is available because the funds are managed by the expert people. It's very convenient, unlike stocks that you have to manage yourself. Here, there are other people managing, so you put in an SIP or you put in a lump sum money and you can rest in peace. The most advantageous thing in this is that you can start with a very, very low amount. Say you 500 rupees, you can start with an SIP of even a 500 rupees per month, and you can go up to very, very large kind of investment. Though there is a research required as to which mutual fund should I buy, but comparatively it is lesser than researching each and every stock where we are going to invest. Let's go to the next slide, please. Now, this is why the research is required. You see the types and categories of mutual fund. When you see this slide, it is actually mind-boggling. There are various types of funds. I have just put some of them. There are debt funds, there are hybrid funds, there are overnight funds, there are funds with very special returns, exchange traded funds, ELS. Most of the terms the viewers may be used to. Some of the terms they may not be used to it. So there is always a question mark as to what fund should I buy. Should I buy a hybrid fund? Should I go into a debt fund? Should I go into equity based fund? Or should I buy a mixture of all this? Now, when I buy a mix of all this, should it be all in large cap? Should it be in mid cap? Should it be mid and small cap? Should it be dividend oriented? Should it be growth oriented? Should it be a regular fund? Should it be a direct fund? And all these queries are then managed by 40 to 45 fund houses. Each fund house has their own fund. So which fund is doing better? So if you sum total it, the total category which you should look into goes close to 1500 plus, or maybe as Zerodha puts it or Angel One puts it, there are 4000 plus categories from where you can actually select which mutual fund it is. So it is not that simple also, and that's why one needs to understand what these funds are. So if we have done this, I will take some time. I'll try and explain various kinds of funds as to what it means. We will start from the left. Debt fund means that the fund manager is putting every fund in the debt. So if he goes everything in debt, that means either government bonds or FDs or certain bonds like infrastructure bonds, etc. The yield will be less. Equity means that the fund manager is putting your complete money into equity. That means he can go into stock market, he can pick up the best of the choices of either large cap or mid cap or small cap or a mix of that pack. The way he proportions the money into large, mid and small cap itself give rise to a number of funds. So if he is putting completely in large cap, it will be a large cap fund. If he is putting in mid cap, it will be a mid cap fund. It can be a mixture of large and mid cap, then it will be a large and a mid cap fund. If he is putting in all funds, then it is also called as a multi-cap fund. And there is something called as a flexi cap fund, whereby he puts into the stocks, but there is no restriction on the fund manager how much money to put and where to put. So he's got a flexible approach that today if a particular stock is doing well, he can get into that stock, he can get out of it, etc., etc. Now, SEBI has actually put certain guidelines so that the fund managers are going in the direction in which the investors have bestowed confidence on them. So suppose I want to play very safe. I said, okay, I only want in debt fund. So the fund manager will be, or who's managing the debt fund, will be duty bound to put only his money in the debt fund, in the debt scripts. If I am again saying safe that I want to be okay, I don't want to be in debt because it doesn't give me much of advantage. So I want to be only in large cap fund. So my portfolio is safe, it's on large cap. That's the requirement of the user. So then the SEBI has given a guideline for the fund manager to go only in the large cap. And he has put certain restrictions that how much money he can invest in the large cap, though giving them a little flexibility of portion of fund to go into small and mid cap also. And this the investor knows that okay, when I invest in large cap fund means majority of my money will be earning its income from the large cap stocks. And if somebody is wanting to take little more risk, he said, I leave to my fund manager, I'm very confident about it. So he goes for a multi cap or a flexi cap. Now, in a multi cap fund, the fund manager can invest his money into large cap, say 25%. Now, these are guidelines. 25% he can get into mid cap, and a minimum of 25% he can put into small cap. The balance 25%, which is balanced with the fund manager, he can decide where to put. He can make 50, 25, 25. He can make it 25, 50, 25, or he can make it 25, 25, 50 in the order of large, mid, and small caps. So that gives the flexibility to the fund manager in a multi-cap scheme. Now, what happens in a flexi cap? In a flexi cap, even this 25, 25, 25 restriction is removed, and a certain amount of flexibility is given to the fund manager that okay, the 65% of the amount of the fund will definitely go to equity. But in what portion you want to put in equity? It has been given to the fund manager. So he decides, okay, let me go today at 30% in large cap because large caps are doing well. As we saw in the last year, small caps had run away with a big success. So a flexi cap would have actually shifted the money from large cap into the flexi cap. So you would have got more returns. Now, this restriction, once gets lifted from a fund manager, it gives him a little freedom to be able to invest in your money into the funds that he feels will fetch better returns. And because the freedom has been given to the fund manager to this extent, these become slightly risky. What if his wisdom fails, or what if his wisdom is not able to deliver that kind of amount? So, high risk, high gain. What I have spoken so far, and what I spoke in the last episode, is that the basic of even the mutual fund is ultimately the stocks only. The only thing is that in that the investor himself had the knowledge of the stock, so he could directly get into it and he could directly buy. Here, since we don't have the direct knowledge, that much knowledge of the stocks, we don't have that confidence. So we call a person who's professional, give him the money, and tell him, "You please invest for us," and bank upon him. So this is the only difference. Otherwise, the money that is earned by a mutual fund is also through the stocks by investing into the stock market. So I hope I made this aspect very, very clear. Just to tell you about the type of fund houses we have got, everybody knows most of them: HDFC, SBI, ICICI, Templeton, Quantum Mutual Fund, Taurus Mutual Fund, UTI Mutual Fund, and n number of them. Now it is up to you to gain confidence on a particular mutual fund to be able to invest in that. So suppose you want to go to a large cap fund, but you are deciding whether should I go to a HDFC or to ICICI or to SBI large cap. So that becomes again a matter of choice by you. So you will have to actually study these stocks against certain parameters and the risks that these people are taking. So how do we carry out this study? After all, it is not blind. So for the people who don't even want to do this much also, there is a fund called index fund. Now index fund is very good. I said I don't want to do any study. I am happy with a particular fund house, say HDFC or SBI. These are the two leading banks in our country. So I just took their name. nothing for them or against them. So say we have confidence in one of them. I said, okay, I will buy the index fund of SBI. Simple. Index fund mirrors the growth of the Sensex oblique Nifty. So Nifty grows, your fund grows, your NAV grows, and you grow along the Nifty. As I showed in the last time, that the Nifty had grown 22 times over a period of 30 years in the last program. From 1995, I think from 1,000 points, approximately 1,000 points, till 2024, it had become approximately 22,000 points, where it stands today, plus minus a few hundreds here and there. So 20 times, 22 times it has grown. So the index fund also will grow accordingly. So the CAGR of index fund will mirror the index, will mirror the Nifty. So this probably is an answer to those people who don't want to invest, apply too much of mind. But is this the solution? No. It is a
Sir,
simple solution.
if I may interject, sir, एक what is this hedging fund, sir? एक hedging fund भी होता है, sir.
Yeah. So what happened is when there is a too much of risk, now you realize that each of these funds have got some amount of risk. So you hedge the risk against a particular item which you feel is more secure in times of crisis. So there is a gold fund, gilt fund. Gold is a hedge. It is the same hedging that we do in the stock market. So a fund manager, he hires that kind of property or equity or asset so that his funds get hedged. Another important hedger are medicals. So whatever may happen, the medical aspect of it provides a very good hedge, whether it is pharma industry, whether it is laboratories of pharma. Even in COVID time, they were booming. So medical is one such instrument where you can carry out hedging. So hedging is that aspect which is less volatile as compared to the market. Now the fund manager identifies what can give you the hedge in case some crisis happens. Suppose there is some XYZ event, unnatural event, which you are not prepared, and all this small, mid, and everything, including Nifty, they dive down. Like what happened in 2008 Lehman Brothers crisis, what happened in 2019, what happened before that. And if you go back into recession, what happened at those times in 1923, etc. These are not known to us. So today we are sitting pretty. This kind may happen some years from now. God forbid, shouldn't happen during our time, but it may happen. So when that happens and fund manager wants to hedge some money, so this is how he hedges that money. He has that also in the portfolio. So that these funds are called hedge funds. So you can decide, okay, along with my large cap or multi cap or thing, I also want to have one hedge fund. And also the fund managers keep certain money that outside the SEBI guidelines, certain money in cash in hand. That is to exploit the opportunity. So
Sir,
whenever
मेरा
the
एक और डाउट है, सर. ये कॉन्ट्रा क्या है, सर?
it's a contrarian call.
Yeah.
Like if something is going down today, say for example, the housing sector. I'm just giving an example, arbitrary example, just for understanding. If the housing sector has not done well in the last 10 years because there was a dip in recession, so everything related to housing sector, whether it was paints or it was adhesives or it was furniture or it was this plies, etc., they did not do that well. But we know for sure that housing sector is going to pick up. It's just a matter of time. It's going through bad patch. So now I take a contra call. I said, okay, I'm getting this very cheap. My investment horizon is 5 to 10 years. I don't have to bother about it today. I take a contra bet and I say I'll take a contra fund. So there are funds which are designed as contrarian funds. And the fund manager then studies which asset is in the contrarian mode right now. And those contrarian funds are also created and available in each fund houses that, okay, for today, this is my contra fund and I will go into that. So that's what is the contra. It's a good question. But I'm surprised you not put your eyes on FOF. What is
Yeah, no. I
FOF?
was about to ask you. I was about to ask you that, sir.
FOF is another very classic example of how much people want to play safe. FOF is fund of funds. So they say you have diversified, very good, everything is very fine. Please go back. But
Yes,
I
sir.
would like to invest my money in all the funds. I want my already a fund has got 30, 40 scripts. And I said, I want 5, 6 funds. I want to invest the money in funds. So actually it become a fund of funds investment, where a fund manager is not investing into stocks. It is investing into Rebecca large cap, SBI blue chip, and HDFC top 200. He's investing into the funds, into the NAV of the funds. So just imagine in a fund of funds, when each fund has got about 40, 50, 60 scripts, in a fund of fund, how many scripts will be there? You will be holding some 300, 400 scripts in one fund itself. It
Sir,
is too,
this
too.
this reminds me, ये इलेक्शंस के जो वो देते हैं सर predictions और exit poll actually. So there are some channels who give poll of polls, कि various companies से क्या क्या poll दिया है उसका average निकाल कर. So it's something similar. We can draw a parallel to that, sir.
Yeah, well, you can say poll of polls, it's a fund of funds.
A
Yes,
fund
you're
of
right.
fund.
Yeah, but poll of polls is like you're taking an average of the whole
Yeah,
average. This
correct.
also is like average returns of even the further average returns being given by
Okay.
the various funds. So I thought I'll just close here, and I'm sure ELSS everyone is very, very aware of, equity linked savings scheme. But I want to clear one myth over here. People think ELSS funds give less returns. This is a general feeling. A lot of people spoke to me, sir, I invested in ELSS fund only to save taxes. But that is not the saving taxes is one good aim. So straight away, if you are in the top bracket, you gain 30% reward by in terms of your taxes being saved. But where does the fund manager invest as far as the ELSS is concerned? Even in the ELSS fund, just for information of everyone, the 65% of the portfolio is allocated to the equity market. So what is the difference between a large cap or a multi cap or a flexi cap? They are also going to equity market 75 to 65%. ELSS is also going to 65% in the equity market. So do you think ELSS is a good fund? In one way, it is good. One, it is giving tax benefit. Second, there is a lock-in period in ELSS. Now, what happens? Most of us are myopic. We invest in a fund and we want the returns the next year itself. That is now how the stock market works. Now, if very simple example, suppose you yourself raise a factory and you make a product, then you market it and sell the product, then the rewards start coming. All this whole process takes time. And if your product is good, the yield over the next 2 years or maybe 3 years or 4 years will be much more than what you got in the first year. What we do, we invest into a stock or a mutual fund and we want the yield the very next this year itself. Whereas if you wait over long terms, which I will show you later on, what is the advantage of power of compounding, that the yields are much, much higher. So in a way, equity linked saving scheme, by virtue of having a lock-in period of 3 years, gives you a lock-in. So you can't take out before 3 years. And you take that advantage of power of compounding in the ELSS. So in my mind, ELSS is also a very competent fund where we must all invest besides looking for the tax gains. So now, if I have to give some kind of very initial thought about it, out of this, what fund should I buy? So you select a good fund house, and purely going by the funds, you pick up one, say, large cap. But I will not recommend large cap to the people who may be thinking large cap. Why? Because what is a large cap fund? A large cap fund is that you can only invest into large cap equities. And what is large cap equities? The top 100 equities in the stock market. Now, in this stock market also, the top 100 also, some equities are not doing well. Some 10-15% stocks are going through rough patch. So a fund manager will have only about 80% of the stocks to play with. And considering the size of a large cap or of any mutual fund, which is about 45 to 50 odd stocks, the play available with the fund manager is only, he has to select 50 stocks out of those 80 which are doing well. He doesn't have much of choice. Similarly, if you go purely for a mid cap, what are mid caps? They are 101 to 250 as per the market value on the stock market. So total 150 funds. Being a mid cap, the chances of funds going the stock going little bad are more, say 20 to 30%. So what is available to a fund manager? 100 to 110 stocks to pick up from. Again, 50 stocks to pick up from 100 to 110. Not much of flexibility is available to them. So purely large cap and purely mid cap is not a generally recommended fund from this perspective. So what is recommended? If you combine the two, it will have the power of the large cap and it will also have the growth of the mid cap. So one of the funds that I generally recommend or speak to the people is look for large and mid cap funds, which will give you reasonable amount of stability. So that is the fund you should be looking for, large and mid cap fund. As far as the
Sir, I
category,
think we'll go ahead, sir. There's a lot of
oh,
ground to cover. Sir,
okay,
if you
okay,
don't mind, I'll request you to conclude, sir, what you're saying before we go ahead, sir.
okay. So actually, I was coming to the question of how and what to select and why to select. So it's part of one of these things. So that's where the large and mid cap comes, and very quickly multi cap and flexi cap because of the flexibility available to the fund manager I just explained, and the ELSs I just explained about the tax. So these four funds, if you look into in your category, should be more than sufficient for anyone to invest. Rest is up to him based on his choice. So let's go ahead. Okay, fine. Let's talk of certain expenses. So when you buy a particular mutual fund, you do pay certain charges. I've just uh, put it schematically over here. So generally, broadly speaking, the expense ratio when you buy a particular thing, there is a company which is working, that's a mutual fund company which is paying its staff and rental for its place, office, etc. Those charges they take up to approximately 1% of your invested value. That is what the load they take. This varies between 0.45% to going up to 0.85% and maximum up to 1%. Now, besides that, there are certain other loads also. There used to be an entry, there used to be something called as an entry load some time back. Now, that has been done away with. So I think from 2006-7 onwards. Otherwise, there was some entry load fee also that we were to give when we were buying. There is a transaction fee. Every time we transact of an amount more than 10,000 rupees, some 100, 200 rupees are also charged as a transaction fee. So, and the fund, if it is more than 50,000 crore, the fees is lesser because it has got greater fund. If it is a smaller fund, the fees is more. So all these things you should see when you are buying the fund. What is the what is the AUM of that particular fund before you invest? Because that much of loading will be done to you when you are actually getting into the fund. And besides that, there is something called as an exit load. Exit load is, suppose you want to exit a particular fund, uh, if it is before 12 months, then you have to pay certain charges. It is also limited to approximately 1% or less than 1%. Besides that, there is one thing very important which I want to tell, I'll cover here itself, which is a regular fund and a direct fund. Now, in a direct fund, you directly invest into the fund by interacting with the fund management agency. Whereas into a regular fund, you bring in another regulator in between, another company, say some broker in between. Okay, you go through me. I will tell you which fund to go into if you are not able to select this. So that regular, when you go regular, you another pay up to 1% of your total fund value. So there are small places where you are actually wasting your money. Together, if you total, you have wasted almost 3% of your investment. So 100 rupees means 3% gone, only 97% get invested. Now, if you compound it over a long period of time, even 1%, if you do it over 10 to 15 years on a corpus of say 10,000 SIP, it saves you a couple of lakh rupees in your end value. So we must look for these small holes where we don't drain out our hard-earned money. This is
So
also
you
one way of
so
looking
you
into
recommend we should go for direct, sir.
100%. Direct fund, in that also growth fund. There are growth fund and there is a dividend fund. Dividend fund keeps giving you dividend back on which you have to pay taxes. So we don't require a small amount of dividend which is coming back to you on a corpus of 1 lakh dividend, maybe 3%, 2%. It will come from time to time. So it's better that you go for a growth fund. Your dividend gets accumulated in the NAV and your NAV increases more and you get more value at the end, together value at the end, and you enjoy the power of compounding even in a growth fund. So it is direct growth fund and those type of funds, and certain risk I'll be covering as we go along. I just wanted to, if you can come to the next slide, if you have done with this. Yeah, I just wanted to show you what a fund looks like. This is from Money Control. Anybody can access this site. I just taken HDFC top 100, one of the funds, no recommendation at all of any kind. But you see, each fund, this is holding 46. I have just highlighted total number of stocks 46. Look at his investment, equity 96%. Look at where it has invested. Large cap may 79%, mid cap 6%, others nothing in zero. It is in small cap, and others 11%. This may also be cash that he has kept it for times to come, or maybe some other hedge investment he must be doing. And now the detail analysis, when you see below, it is listed all the companies. In this particular slide, only top 10 companies are listed. But if you go to the site, you open it up, it will give you all the 46 stocks and the percentage. If you see, if you go into the slide, ICICI Bank, it is holding 10%, almost 9.59%. HDFC Bank, it is holding 7.26%. So almost 15% of this script is in two banks. And if these two banks don't do well, all its rating and all its NAV will go down. So this is also a reason. How do you select? So you analyze the holdings of a particular stock in detail when you are doing this selection while going into a into a direct fund. So this is what I was wanting to bring out. Go to the next slide, please. You see, each of the fund managers sets a benchmark. Now this benchmark is nifty. The yellow one is the benchmark. In a period of time, this benchmark, that is the Nifty index fund, has given 36% return. Now it's mouth watering. 36% is a beautiful return to get in a particular year. It doesn't happen every year, but some years it happened. We had a fantastic 2023, so it has given this return, and it is current. It is up to March 24. So for those people which I said, index fund is sahi hai, index mein dalo, and I got one call yesterday by one of the senior officers. He said, SQ, I have invested in 5 or 6 index funds of different groups. I said, sir, don't have to go into 5, 6 index funds. Just buy 2 of them, any 2 groups that you like, just to hedge, and you will make good money. And he's been doing this for last 4, 5 years. And he said, I'm very happy. His returns were ranging from 20% to 40% CAGR, 4 to 5 years, which is fantastic. So for those, I think index fund is very good, but this doesn't happen all the year, so you should be cautious about it. What the fund managers do, they try and beat this index. So this benchmark, they said, and they beat. Now this particular fund has beaten the benchmark by 4%. It is written in the blue as of now, and this value keeps changing. And below I put certain details like exit load I was talking about. HDFC top 100 charges 1% of exit load if you go before 1 year, and nothing after that. And likewise, expense ratio also I've written here. The expense ratio of HDFC top 200 is 1.65% as it has declared. So 1.65 gone there, 1 gone into exit load if you exit before 1 year. So 2.6 gone. And on top of that, if you had taken a regular fund, 1 more percent to be added. So 3.65 gone. So that's how you start losing money. So this is what you should be careful about. I'll give one more example. Go next slide. Here is another fund. This is my flexi cap fund. So it's a flexi cap. But look at the number of stocks it has gone into 72. 72 is a hell of a lot of stock. And because it has increased the number of stocks so much, it is too much diversified. So though Myra is a good fund house, but look at this particular flexi. It's a regular fund. It's a regular plan. It should be direct growth. So if you see below that, regular and direct, those two things are written. So you should go for a direct plan. You can invest yourself. Now, what I also wanted to bring out in this, go next slide, please. You look at this. It could not beat the index. 43% is index in this particular case, and here the index is 38. He has only got 38%. Not that it is because of 72, but maybe also that was one of the reasons why it could not beat that. Just go back one slide, please. One more thing I wanted to tell. Yeah, here. Now you see that where he investing the top 10. Again, HDFC Bank and ICICI Bank. You see the investment, almost 13% combined together. And if you see the other ones also. So most of these funds in this category in large cap, as I told, the best large caps have to be from that 80. The best mid caps have to be from that 100. So more of these funds will often have 25 to 30% of the stocks common. So whether I buy HDFC or I buy SBI or I buy Myra Asset or I buy UTI, the fund manager would have picked up the best stocks to put into it. So when you analyze that, please do carry out the detailed analysis. And if you buy 2 funds, don't be into the same stocks in 2 different funds. Not worth it. Might as well be in one fund, which will give you better result, and whichever you feel comfortable based on the other risk factors.
Yeah.
Now, what are the other risk factors? I'll just cover that because that's very important. Before I come to this is slightly technical. All of you may not be able to go into it, but there are certain ratios which are there. I thought I'll just put it, I'll seed it at the moment. There is a ratio called standard deviation value. Now, which stock has deviated from its own standard, and how much it has deviated gives the volatility index of that particular stock. Lesser the deviation, less volatile it is, more chances of giving a similar return in the next year. Similarly, there is a beta value. What is the deviation of this particular stock from the funds in the market? Suppose in large cap funds, somebody has got a value of 12.5 and this guy has got 10. It has deviated by 2.5. Other stock is deviated only by 1.5. That means that is more stable. That is beta value. And there is alpha value which is also generated. Again, deviation. So these are Jensen alpha deviation from its own self. From its own self, how much it has deviated. And then there are other. See, I as a fund manager versus you, I can take more risk, you can take less risk. But people would like to go to a fund manager who's giving the best returns without taking risk. So if I am taking more risk, people also judge me. Yeah, he has taken so much of risk, but has he been able to give me that kind of return? Is the returns adjusted to the risk he has taken? Because if this risk has not materialized, I have lost my money. That's how people go into it. Even if that becomes, that's called as a trainer ratio. So there are other ratios also. When people ask me, how do I select my funds? The first 3-4 types I told you. First, get into what type of fund you want: open-ended, close-ended, equity, mutual, and equity into the hedge fund you brought out. Which type of funds? And after that, then analyze each fund, and then how many funds I told you, 3-4 at the maximum. And then after that, once you have gotten all that, look into the risk parameters. If you stand at 2 funds, another good thing to see is how the fund has performed in the last 3-4 years. Definitely, that is not any signal that the same performance will happen next year also, to be taken with caution, but it only gives you an indication. If there is a change in the fund manager for whatever reason, you must definitely, as I showed in the last slide, fund manager name is given. You
Yeah.
go to the Google and just read about that fund manager. And if the fund manager has been changed, if he has gone for his own upgradation somewhere else, follow him because he has given you good returns. But if some fund manager has been removed because of bad assets, immediately get out of his script. So these are other indicators which should be kept in mind for those persons who are directly going into direct growth stock. So I thought I just covered those why and how to select also. We can move ahead. Yeah, next slide. Yeah, so I just now was wanting to give you certain returns just to give you how the returns are. You see, this is one screenshot from one of the platforms. I've used some filter. You see the filter I've used: equity funds, flexi cap. Total number of years, 3 years. Returns are for 3 years. It is CAGR, annualized returns, 34%. I mean, it's fantastic. 29%. 20. These are in the order of highest to the lowest.
This.
27%. And likewise, it goes down. Anybody can see this. So these are really some mouth-watering kind of performances given by a flexi cap. Go next slide, please. You change the filter, equity fund, flexi cap, 5 years. Imagine the funds may change, but look at now, the quantum was at 2 or 3 position, 30% returns over 5 years CAGR. I mean, even a good stock market guy cannot do it in one stock on his own. So why can't we leave our judgment to these mutual fund guys, these professionals, provided we have selected the fund correctly? And since we all, suppose we find it difficult to select the fund correctly, that is where I recommend that then you go to that mediator, you go for a regular, go to a particular investor who will tell you which fund to buy, and he will charge you a fee, that 1% fee, which is
Correct.
for a regular fund. Okay, go next, please. Certain other things. Now see ELSs. 1 year return of ELSs, 60%. 1 year. This last year. Best SBI long-term equity fund, direct growth, ELSS fund. But there is a lock-in of 3 years, so you cannot take out this money. But if you see over 3 years, this fund will also do
Yeah.
very good. So these are some of the platforms I just put across where you can select. Go next. I'll show you one more platform. Go ahead. This is of another, I think this is of Money Control. You see in 3 years what kind of returns. Everything in the top bracket, returns of various kinds are between 20-25%. Of course,
This
2023
this
also.
this fund would have given tax benefits also in addition, sir.
In the ELSS. In
Yes,
this, you
I'm talking
see
about
the rest.
ELSS.
Yeah, yeah, 100%. Besides tax benefits, the ELSS fund has given this
And
kind
this
of
is
return.
20.87, 33.38 is in addition to the tax benefits.
Of course, yes, tax benefit you already avail in your ITR. You have claimed it.
Yes.
So that money has come to your account. This he has invested this money and has given you this 30%, 20%, and 28% kind of returns. And likewise, you see all the returns. But I want to caution here by seeing this, one may feel yeah, everything is very rosy and we should straight away jump into the mutual funds. There are certain bad years also. When you go and carry out your own assessment in certain bad years, these there are negative returns also on the mutual fund that should be kept in mind. We are actually seeing mutual fund in the last 3 years when the market has done really well after the COVID. Twenty
Yeah.
21, 22, 23 have been generally the good years, but certain bad years were also there. Notwithstanding, if you go over a 4, 5, 6, 7 years period, it all gets average out. And when you go to a 5 year slide that I showed you, that 5 year covers the COVID time also, and it has engulfed the COVID thing also and still given you 30-35% of CAGR. So if you go long into a mutual fund investment, it gives you a very, very decent and a good return. And if your goal is achieved, by all means enjoy the profit, take out and
Yeah.
enjoy the money. Go next slide, please. Another way of looking at the fund, this is from the Association of Mutual Fund of India, which is the governing body for all the mutual fund. They also give the next slide, please. So now I'm coming towards the end. Just show you what the SIP calculator tells you. This is for those who want to understand how much my money will grow. Simple calculator, many of them available. I just picked up one. I put some 5,000 rupees as SIP for 15 years. This I have made it. If a youngster joins or any government servant joins, initially he can spare 5-10,000 rupees easily for 10-15 years, like we put in a DSOP or PPF funds, and he just puts into this 12%. I've just taken a 12% and a very, very generic rate of interest which people talk that mutual fund industry gives, and your 9 lakhs become 24 lakhs in 15 years time, almost 3%. Similarly, your 20,000 becomes 99 lakhs, your 30,000 investment in 15 years becomes 1.5 cr. Why I've done this? Because some people who have missed the bus early, we are in the middle of our service career, we come to this, we we are having good money, so 30,000 ka we put a SIP for 15 years. By the time we retire, we have a 1.5 cr corpus in our mutual fund itself. Now, go next, please. But the magic is here, power of compounding. I don't do anything. I started as a youngster, I started my career with 5,000 rupees. I just kept putting it for 30 years. I waited for my retirement. Look at the corpus. I invested only 18 lakhs with just 5,000 rupees and I've got 1.75 crore, 10 times. This is what one should aim for. And those who are youngsters listening today, if you have missed the bus, 5,000 today is very small amount for people who have got a decent job. Please invest. Please invest wisely and 2-3 schemes. And after 30 years, you will get. And if you put in SIP through the bank, you won't even know. Bank will automatically cut the money. You won't even know that your money is going. So that is what the power of compounding is. Next, please. These are certain platforms where you can buy these funds. So Zerodha gives, ET Money gives, Camps. All there are n number of platforms. This app I put in Money app. A lot of people talk very high about this app. This app also, and I'm not using this. I'm not even professing this app. But I have heard a lot of people talking about this app that it takes good control of our money. You can track your money into it. But definitely, I would like you to see Angel One mutual fund column if you have all those who have the account in Angel One. It's got a very, very great flexibility. All these parameters that I spoke about, when you go and open the Engine One platform, it has got almost 27, 28 parameters where you can select, I want to go for large cap, I want to go for multi cap, or I want to go large and multi cap both, and I want risk profile this much, expense ratio this much, I want to go into this particular fund. So all these variables he has there, and then you press enter, it gives you result. Okay, sir, with all your this query, these are the funds you should look into. So it makes your initial screening so much easier. I found this particular since I'm using this app, I found this most beneficial to me. Anybody puts a query, I go to this Angel One app and I definitely use it. So you can use it and find benefit from this, and if you like it, I mean, use it and exploit this. It's a very strong platform which I found. Again, not professing for it, but it's found very easy. So I'm just sharing with my brother officers and other who are listening onto this particular channel. So I think all that is now remaining for me is to tell you that now that you have made good money, you must pay taxes on it. Don't hide this. People don't show it, don't reflect it, and then get caught once you make big money. Every time, whichever fund you go into, there is a very beautiful CAMPS monthly report that comes. In that, it gives you your fund is so much, your tax liability is so much. Please give it to your CA. Your CA will cut the taxes. And broadly, for your understanding, in equity funds, it is like capital gains. Short-term capital gains is at 15% irrespective of your tax bracket, and long-term capital gain is 10% without any indexation. Indexation only happens in property. It is without indexation. This is the tax you have to pay. Simply saying, if you made 1 lakh rupees in short-term capital gain, 15,000 रुपये आप tax में दे दीजिए. But if you have made 1 lakh rupee long-term capital gains, up to 1 lakh, there is an exemption. Anything beyond 1 lakh, you pay 10%. Other funds which are not equity-based funds, there the taxation is at a different thing. Holding period is 36 months. And in long-term capital gains, it is at 20% with indexation. And there are certain other little points in between. So study this taxation part little more carefully and definitely consult your CA, because we are all filing our returns through our CA. Have a word with him, or if you are not also, you can just go to the income tax site and read about this. It is very clearly available as to how much tax we have to give. So that takes care of your tax and you can sleep very, very peacefully. I think I have done with as far as mutual fund is concerned. I just want to tell you one thing, that all this education mutual fund industry is also trying to give to all the users. I was seeing the AMFI site where they are saying that every year they are conducting these camps where the mutual funds are told to go to particular cities, conduct the camps. I think they should be doing it for free because it's a direction of AMFI, and they are educating people on some standard kind of a presentation. I'm yet to face one. I never got an opportunity so far. Now I look for it and also get more educated as to what these people are telling. But I think that would be a good avenue where you should go if you get to know and get educated more as to what these professionals are talking about when they are talking about their own industry. So far, they claim that in the year 21-22 to now, they have conducted some 8,500 odd programs, and they have educated about some 5 lakh participants into it. But it has not touched all of us. So they also need to do much more to increase the awareness of those 80 million people I spoke about who are in the bracket of either earning or retired, who can really invest. So they also need to do more. And through forums like this that we are conducting, I think we are educating our own small little body and making them aware of the benefits of the mutual fund. So I rest my case here for today. If there anything anybody wants to ask,
Yes, there are questions, sir. We'll take on the questions just to save time. JVJP asks, but hedge funds based out of USA have been responsible or culprits for a lot of financial destruction in global market in past years many times. Your views?
oh yeah, fine. So all these fund managers, I will not say fund managers, all these funds can be manipulated by people who are managing this. In fact, I was just 2-3 days back. Why USA? Even in our country, there are some people. I will not name them on this open forum, but it's available in the news that a particular fund house, despite having so much of tightening that you can't do the trading of the funds on your individual platform, etc., etc., but to give flexibility to the workers, gave a particular option which some smart mind exploited, and they carried out the trading just before the trade was to happen in the normal time. So these kind of lacunae can be exploited by the people. So it's very much possible. In USA there have been bubbles of property. There have been
Yeah.
so those kind of things would have happened, and I don't know what particular thing he's hinting at, but yes, there is a possibility of that, and that is why we should go for a very good fund house where these best practices are available, so that we are not duped by those people, those professionals on whom we are putting our confidence that they're only duping us or the funds going so duff. That's the reason why we said we should go for them.
Ravindra Agrawal, he says, I think mutual fund are best for normal people. There's a follow up. But people of army officer caliber should invest directly into equity or debt fund as per his investment target.
No, I can't agree with him more.
Uh,
Ravinder, I started with this, that mutual funds basis is equity, and people who are not able to understand equity come to the mutual fund.
yeah.
But if by some virtue you got a hang of the equity, why should you bank upon them? You please have your own goals. Select your 10, 20 best equities. Why large cap? You go into the small cap, you go into micro cap and make percentage profits. But I will, since you have excited this particular idea, when I do my own equity, one equity to me has given me 300% return in this year itself. So when those kind of returns are available in the equity market, but then the risk is very high. It's a
Yeah.
micro cap, just 1,000 crores capital. But yes, I invested after some study. It's given me almost 300% profit, and I made good money on that, and I'm holding it. So, and the chances of that equity going into a, if it is
Yeah.
market cap is 1,000 crore, for it to go to 20,000 crore, it has to multiply 20 times. And suppose I see that equity going to 20,000 crore in next 5-10 years, my capital would have grown 100 times. So the opportunity in a direct market is very, very huge in the equity. But this is definitely meant for those people who can't take that chances, who don't have that knowledge and want to exploit the expertise. That was the start point, and I can't agree with him more.
Kalarpi, sir, better to buy mutual fund or go for SIP? This more or less you have answered, sir. Safe and best option for seniors oblique senior veterans below 65 plus is mutual fund better or SCSA, the senior citizen, I think is referring to security, MIS or PPF.
Roger, sir. So this is a very good question. Anything related to equity comes with a risk. We must understand that. It totally depends on the mindset of the senior citizen. When I consider myself senior citizen, I have a different take, which I keep telling people that you have done all your liabilities are completed. Now this corpus that you have with you, 10, 15, 20, 30, 40, 50 lakhs, whatever you have, you are now having this corpus available, or 50% of that corpus you can take large amount of risk. बच्चों की शादी होगी, सब कुछ खत्म हो गया, nothing, just money which is lying. You can't even eat that money. So take risk and grow it for your kids, grow it for investment for your generation next. Why just keep it in the safe investment? Nothing is going to be taken away from, especially people like us who are also having a lot of pension. So the simple answer is that definitely mutual fund has risk, so you must take that risk. Mutual fund is a safe risk, so some percentage of your money you should take. PPF, yes, PPF is a very good instrument. It's like DSOP. If somebody has opened a PPF, you must continue investment in PPF. Monthly income plans, that MIFs, should only be taken by those who need additional income over and above what he is getting because of certain requirement he must be having. For them, that is good. He should take that and put part of the money into that. But I feel all our retired brother officers and officers from the other field should look at mutual fund as a model with a little amount of risk. It's a much safer investment and with good returns.
About risk only, his follow-up question is fund manager of bank public other is accountable, how to trust?
See, he's only accountable to his company and his own growth. If a fund manager does badly, he won't get the job thereafter, or he won't be looked into in good light by that company. He is not accountable to you in any other way. You have invested in him. He has tried his best. As long as he has not done any hanky panky, he has not got into a fraud, he is not responsible. He's used your money, he has invested it. The asset management company is also using its best. So these are the best practices they are following. Unless they have gone into a fraud, they are not responsible.
Absolutely. Sir, I think we have now touched our limit of time available to us. Sir, all it remains for me to say thank you very much. It was an excellent talk, very well structured, sir. And I'm sure our viewers who have joined us live have learnt a lot, and those who are going to watch it subsequently are also going to get benefited. I, for one, can definitely say that I learnt a lot, sir. Few doubts which I had without asking, you had considered it and answered it, sir. Thank you very much, sir.
Thank you so much, Rakesh, for this opportunity. we'll look forward to more such interactions depending
Yes.
on the viewers. Thank you so much.
Thank you
Thank you.
very much, viewers. One small little announcement. We have another podcast coming at 7 in the evening with different General Dushyant Singh as my guest. We are going to talk about the Asia chessboard, the race to win over Bhutan, Nepal, Maldives, and Sri Lanka. What is China doing? What are we doing about it? Please join us live at 7 in the evening. Thank you, sir, and see you soon. Jai Hind, sir.
Thank you. Jai Hind.